The current economic climate is fraught with uncertainty as the specter of stagflation, a period characterized by stagnant economic growth and persistent inflation, casts a shadow over the financial landscape. Jim Rickards, a renowned financial expert, has recently sounded the alarm, predicting that the United States is on the brink of stagflation. This dire forecast, if it comes to fruition, could have devastating implications for an already teetering stock market. This article delves into the intricacies of stagflation, examines historical precedents, and explores the potential consequences for investors and policymakers alike. Stagflation, a portmanteau of stagnation and inflation, refers to an economic scenario where high inflation coexists with high unemployment and sluggish economic growth. This situation defies traditional economic theories, particularly those adhered to by the Federal Reserve, Fed, which often assume an inverse relationship between unemployment and inflation. According to the Fed's models, low unemployment typically leads to high inflation, while high unemployment should drive inflation down. However, the reality of stagflation challenges this assumption, presenting a complex and troubling economic paradox. To fully grasp the potential impact of stagflation, it is essential to revisit its most infamous occurrence during the late 1970s and early 1980s. During this period, the United States experienced double-digit unemployment rates coupled with soaring inflation, peaking at 15%. This era of economic malaise was marked by stagnant growth, high interest rates, and widespread economic hardship. The Fed's traditional tools for combating inflation, raising interest rates, proved ineffective, as they simultaneously stifled economic growth, exacerbating the problem. Jim Rickards' recent warning serves as a stark reminder that the buoyant market conditions of today are underpinned by fragile economic fundamentals. He posits that the U.S. is on the cusp of another stagflationary episode with early signs already apparent. The implications of such a scenario could be dire, eroding purchasing power, squeezing corporate profits, and leaving policymakers with few viable options. The stock market, currently basking in the glow of record peaks, could face a severe correction as the delicate balance of investor confidence shatters under the weight of economic reality. The Federal Reserve finds itself in a precarious position, balancing the need to control inflation with the imperative to foster economic growth. Since March 2022, the Fed has embarked on a series of interest rate hikes, raising the federal funds target rate from 0 to 5.5% by July 2023. Despite these efforts, inflation has remained stubbornly high, with the Consumer Price Index, CPI, lingering between 3% and 3.7% since June 2023, well above the Fed's 2% target. The market's relentless surge to all-time highs hinges on the expectation that the Fed will implement 3 rate cuts this year. Such cuts typically ease business operations and bolster consumer spending, fostering a more dynamic economic environment. However, this optimistic outlook clashes with the stubborn reality of persistent inflation. Cutting rates in this environment could exacerbate inflationary pressures, undermining the Fed's credibility and potentially igniting further price surges. For the past 2 years, the U.S. stock market has eagerly anticipated a Fed pivot, a shift from rate hikes to rate cuts. Since bottoming out in October 2022, the market has enjoyed a steady climb fueled by expectations of easing monetary policy. This disconnect between market behavior and economic fundamentals underscores the potential for a sharp correction. Investors seem to disregard the possibility that the Fed, grappling with persistent inflation, may not pivot as anticipated. This discrepancy creates a precarious situation, making the case for a significant market downturn compelling. The continuous flow of government money into the stock market, despite underlying economic strains, creates a facade of prosperity. However, the U.S. consumer is stretched to their limits, teetering on the brink of collapse. The echoes of the 2008 financial crisis, triggered by a collapse in subprime mortgages, serve as a stark warning. With consumers grappling with rising interest rates, the pressure mounts. This scenario could lead to increased government funding to support struggling households, perpetuating high inflation and steering the economy towards stagflation. The stock market's remarkable surge, despite a significantly higher risk premium, signals a market driven more by hope than by reality. Many companies are trading at exorbitant multiples, with stock prices rising even as their revenues decline. This disconnect between stock valuations and economic reality is a clear signal of potential trouble ahead. Jim Rickards' warning should not be dismissed. It is a call for caution. Rather than plunging headfirst into the market, investors would be wise to adopt a more conservative approach. In this uncertain economic climate, caution is not just advisable but necessary. Investors must remain vigilant and prepare for the possibility that the seemingly unstoppable market rise could end abruptly, with significant consequences for the broader economy. The risk of a significant market correction later in 2024 looms large, especially if anticipated market shifts fail to materialize. Exiting the market now, while prices are high, could be a prudent move to avoid potential losses when the bubble bursts. The looming threat of stagflation, as highlighted by Jim Rickards, underscores the fragility of the current economic landscape. The disconnect between market behavior and economic fundamentals, coupled with persistent inflation and the Fed's challenging position, creates a volatile environment. Investors and policymakers must heed these warnings and prepare for a period of painful adjustment. The specter of stagflation looms large, casting a shadow over the exuberance of today's market highs and threatening to usher in a period of economic turbulence.